just to level set on what Amcor is today. It's a company that's been around for 150 years, but it's changed a lot. And those that knew us maybe 10 or 15 years ago might not realize exactly what the company is today. So we'll just use slide 8 briefly. First of all, what I would say is we're in 4 product segments in the packaging industry, and we make consumer packaging primarily at this stage. We don't do some of the things that you might know us for in Australia in terms of corrugated boxes and cans and things like that. We have 4 product segments. Half of the business is flexible packaging, which is plastic and aluminum-based packaging for food and healthcare products. We have a global leadership position in that business now, which is something that's emerged over the last 7 or 8 years. And if you look at slide 8, you can see the regional positions we have. We'd be the leader in Europe, the leader in Asia, the leader in Latin America, but we have a very small position in North America, and that's where the Bemis deal comes in. I'll come back to that shortly. We also make rigid plastic containers in North and South America. We'd have the leadership position in both regions. And when I say leadership position, I'm talking about in well-consolidated markets where there are really a small number of competitors. In rigid plastics, there would be 2 duopolies in North America. We would have roughly a 50% share in each. The third product segment is specialty cartons. That's a global business for us, and we would have far and away the leading share globally. And then we make some closures. So the point of the slide is that Amcor now is a pretty focused portfolio. All of the businesses are in well-consolidated segments, and Amcor's got a leadership position in each of the businesses that we play in. The result of that would be on slide 9, which is that the margins have been expanding consistently for over a decade. And so slide 9 shows back to 2008, the EBIT margin of the company was about 7%. Now we're close to 12%, and that's been a pretty consistent march up over that prolonged period of time. That's also driven expansion of return on funds employed, which is the bottom part of slide 9, from about 11.5%, 12% back in 2008 to just shy of 20% now. And so the company's been on a fairly long run of consistent performance and value creation. That's just the quick background. Now, in terms of looking forward, slide 12 would be the one slide you'd want to understand if you were thinking about this as an investment from an equity perspective. This is a capital allocation framework, and we call it the shareholder value creation model. So the way to think about the business is from those leadership positions in the segments that we're in, we generate a lot of cash flow. It's quite defensive because we're supplying into food and healthcare, the consumer staples. And we use that cash to generate value in 3 ways. We pay a dividend, which is traditionally yielded about 3 or 4%. We reinvest in the business in terms of capital expenditure to support organic growth, which typically is about 3 to 4%. That gets to about an 8% return. And then the business generates excess cash above and beyond the dividend and the CapEx requirements. And that tends to be up to $300 million a year. And with that $300 million, we've been buying businesses and bolting on small acquisitions or returning cash by way of a buyback. And so depending on how we deploy that capital, there's another 2 to 5, 6, 7% opportunity as well. So over time, the business has been producing a 10 to 15% return, and that's going to continue going forward. This model will be maintained once we integrate the Bemis deal. And maybe just as a really brief footnote, and we can talk about this if there's interest, slide 13 is around sustainability, which we see as probably the single biggest organic growth opportunity that we have in the business today. This rising need for more responsible packaging around the world is an area where Amcor really sets itself apart from the competition and we believe will drive growth going forward. Now, just to close off, a couple of points on what Bemis brings to us. Probably slide 17 would be the best place to just pause for a second. The business, once the deal closes, will be a $13 billion business, US dollar. All of these numbers are in US dollars. EBITDA will be over $2 billion, and the cash flow generation will be strong. It'll be about $1.2 billion US dollars. Again, focused portfolio because Bemis does purely one thing, which is flexible packaging, and that's what Amcor does in half of our portfolio today. So it's basically, it's not an adjacency or a step out. It's actually just doubling down in our primary product category today. What it does for us from a strategic perspective, there's 2 slides I'd point to. The first one is 19. It basically fills out a global footprint for us. So if you just look at the color scheme on 19, the pie chart on the left is Amcor today. You see a big position or a big geographic weighting towards Europe and Asia. Bemis in the middle has a big weighting in North America. When you put the 2 businesses together, On the right-hand side, you see a very balanced geographic business with a full global footprint. That's becoming increasingly important to our big global customers who are looking for global partners around innovation, among other things. Second big strategic benefit would be on slide 20, and that's the fact that we have a scale position already in most regions, and with Bemis, we'll have a scale position in every region around the world. And what's not on the slide here, but I'll speak to, is just the relative scale advantage that we have. So if we think about each of these regions in flexible packaging in North America, we'll be at about $3.5 billion in sales. The next largest player would be about maybe half or a third of that size. And if you walked around the other regions, Amcor would have somewhere between a 2 and 4x scale advantage relative to the next largest player. So there's quite a bit of scale and quite a bit of daylight that's being created between us and the next largest player. And then lastly, from a value creation perspective, 24 probably sums it up. In addition to the strategic benefits, there's a cost synergy opportunity here of $180 million over a 3-year period, which will drive near-term earnings growth. It's in the areas you'd expect: procurement, overhead, plant closures, plant synergies, and we expect those synergies to accrue pretty evenly over the 3-year period, about a third.